Welcome, this is your Option Monster Volatility Sonar Report. From the floor of the SIBO, I'm Jamie Tyrrell of Group 1 Trading. Well, it's another pretty much unchanged day in the market. Mortgage rates keep falling. They drip below 5.5% today on a 30-year fix. We have the auto bailout vote coming up this week, and so that's kind of looming over everybody right here. But once again, less volatility we're seeing, not the up 30 points in the S&P 500, 3% in the market, down 3%. We're just about perfectly unchanged. So what that does is people continue to take premium out of the VIX. They continue to lower their volatilities. And on that, we talked about the D55 straddle, how that's kind of a bet people are making right now. Are we going to finish outside of 50 and 60? If you make the bet now, that range is narrowed. That straddle's worth about 460. It was worth 5 yesterday, and it's decreasing. The closer you get to expiration, the longer we stay in this 50-60 band. What's interesting is, although the volatility is really going down on that 55 line, people still seem to like to play out of the money options in December. I'm not sure if they're hedging this for protection or if they just think that's a cheaper way to buy VIX premium with expiration approaching. But we've seen a lot of people buying the December 70 calls. They paid 20 cents and they paid up to 25. And another interesting trade was somebody bought 3,000 December 50 calls when the future was up around 55. As soon as they bought those, they paid 65 cents. We saw a huge future seller, and they took the future down from 55 to 53 and a half. They were putting 100 lots of VIX futures on the screen, which is a good deal. If you're going to sell one future, you're selling $55,000 worth of VIX future. If you sell 100, that's $5.5 million. So with the VIX futures as illiquid as they are right now, when somebody puts 100 lot on the screen and starts hammering the bid, futures can run down pretty quick. So that guy who bought the December 50 puts for 65 cents made a pretty quick profit as that future dropped down $1.50, and they've been trading about $1.10 right now. So that was a good trade for that customer, buying the puts right before the futures slammed down. In the back month trading, we just had a big trade go up in March. It was a March 40 call. The customer paid $10.75 on about 3,000, and they tied that up to futures. Like I was saying in the earlier, just a little bit earlier, futures are pretty illiquid in the VIX. And so if you want a market maker to take the other side of an order in March or April or a real back month on something like the 40 call that has a lot of deltas or a lot of its price moves very, very quickly as the price of the future moves, if you tie it up to futures, the market maker is more likely to take that bet. So you say, I'll pay $10.75 for these calls, but I'll also sell you the future for $47.75. You can get a lot tighter market if you tie things up to futures, especially in the back months when things are trading as thin and illiquid as they are right now. It's an easier bet for a market maker to make. So they bought 3,000. Most of them were in the crowd, and that was a bet on increased volatility into March. This is Jamie Tyrrell, Group 1 with Option Monsters, 4 days to expiration.
Aircraft carrier around here?